Thank you for standing by, and welcome to the Liontown Resources Investor Briefing. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Tony Ottaviano, Managing Director and CEO. Please go ahead.
Thank you, Darcy, and good morning, ladies and gentlemen. I'm here with my CFO, John Latto. You would have seen our announcement this morning. Today's presentation is really to provide some further context around the salient points in regards to that announcement. I want to start by providing the audience with a project update. The Kathleen Valley Project continues to be on schedule and on budget. We plan to have first production midway through this year, and we're starting commissioning works as early as March this year. So from a base case perspective, the project is travelling well. Liontown has advised the market in the past around its strategy of accelerated growth. With that accelerated growth meant that we wanted to bring more capacity into a market that was very strong, and the pricing signals were very appealing for us to put in more volume into this market. We've seen over the passage of the last 12 months a significant reduction in the lithium price, to the tune of over 90%, to the point where today we're facing a spot price in the order of $875, whereas the start of last year it was close to $7,000 a tonne. Now, as a company, we have a view as to what we think the medium to long-term view is of the price, and whilst our view differs, the majority of the forecasters see it differently. So when we look at the forecasts that have come out in recent times, there has been a sharp deterioration to the tune of up to 60% reduction. So on that basis, when we announced our debt facility on October last year, we had a view by an independent pricing forecaster of what the medium-term outlook would look like in terms of the spodumene price. That view has changed to such an extent that the commitment letter provided to us by the banks could not be supported, and therefore we had to terminate. We have a very supportive banking group. All 8 lenders have advised us that they will continue to work with us and work through a smaller and more nimble funding package for us to go forward. I think it's important to note that, as I said, our base case remains the same. We are progressing towards our 3 million tonne run rate. We have $515 million in cash in the bank as of the end of December, and we've got sufficient funds to complete construction. We want to use this time to work with our banking syndicate and work through a more prudent and fit-for-purpose debt facility. And as a consequence, we will review that accelerated growth strategy and design something that we both feel strongly about. I also want to mention that we are building a very strong team in order to finalise this execution. The market remains challenging, but we have confidence that over the passage of time we will see an improvement. So that's basically what I wanted to add today. I'll now turn to Darcy to open the line up for questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Hugo Nicoli from Goldman Sachs. Please go ahead.
Morning, Tony and John. Thanks for the update this morning. Maybe just a couple of questions from me, if I may, but maybe just firstly a clarification. Can you just now confirm you're no longer repaying and closing that forward debt facility?
Yes, at the moment, the forward facility stays on foot.
Okay, great. So in that case, then it's probably fair to assume that part of the lender reassessment around debt capacity, that total debt capacity has come back. So simplistically, before you take out the pricing adjustments, that lending syndicate should have probably come back from 760 to 460 million if you're keeping the forward debt. So then just can you talk to maybe the ballpark of available debt you're talking to with that syndicate at the moment, what the composition of time and timing of that might look like, and then is there any risk that with lithium prices still falling, you might not actually have certainty around a funding package there for another couple of months? Thanks.
Thanks, Hugo. Your skid mass was correct. So based on the 760 we announced previously, you take off the forward debt that will stay on foot. So the fresh debt, if you want to call it that, was the 460. What we're aiming to do in the next coming weeks and months, as we've indicated on, is to look at what the resized debt facility will look like, and it will be lower than the 460. In terms of the lithium prices and potentially lithium prices going forward, the price forecast that we use as part of our banking syndicate arrangement is the WoodMac forecast. And the WoodMac's January update has indicated a significant reduction in the medium-term price to the tune that we're seeing in years 27 and 28 and 29 about 950 CIF, spodumene price. So to me, is there a risk that the price goes forward? I think I'm not here to sort of speculate, but that is a very, very low price.
Thanks for that, Tony. So then maybe just jumping from funding across to how you're thinking about the projects, maybe if you could just elaborate around some of the review options you've touched on in the release around what the further cost optimizations you're looking at are, and then just around the mine sequencing and changing that. Understand that had already been changed. So what other flexibility you have and what you're expecting the impacts around ramp up, head grade and recovery impacts could be if you do change that sequencing.
Yeah, that's a very good point. So let me elaborate. In our October announcement, we said that we're bringing forward the 4 million tonne development work to now so that we can provide ourselves that insurance and risk mitigation around delivering the 3 and then ramping up to the 4. So when we brought forward that development work, we brought forward capital. Now, with the market outlook as being predicted by the independent experts on forecasting, we're sort of questioning whether or not do we really want to bring additional supply into the market when they're forecasting an oversupply. So what we're going to target is whether or not it's prudent for us to spend that upfront capital on accelerating the 4 million tonne underground. Now, the 4 million tonne capital cost to build and expand the plant will also, as a consequence, potentially be deferred. So there's some saving there. Then on the resequencing, if we look at ramp-up schedules and with us now slowing down or potentially eliminating the accelerated development at Northwest, there may be some tonnes and grade benefit, but we need to work that through in the coming weeks and months.
Great. Thanks, Tony. And just one last one I'd squeeze in. What is your total capex around the 4 million tonne development expectation at the moment in terms of mine and processing? And what did you think that going to 4 million tonnes could potentially reduce your unit costs by?
Yeah, so the capital cost for the process plant upgrade was 70 million, approximately, Australian. The development work for the 4 million tonne, the additional cost for that development work, I don't have that figure on, 36 million, John tells me, right? And in terms of, potentially what does that do to our operating costs, the volume benefit that you get from the extra tonnes, I couldn't tell you offhand.
No worries. I've probably asked more than my share. I'll round back. Thanks, Tim.
Yeah.
Thank you. Your next question comes from Alex Papon from Citi. Please go ahead.
Hi, Alex.
Hi, Tony and John. Have you had any discussions with existing strategic shareholders or offtake partners to provide alternative funding solutions?
Alex, all of this has been relatively fresh. We will now commence a discussion primarily with our banking syndicate initially, given how strong their support has been in terms of finalising the debt facility. We have ongoing discussions with customers around our downstream and potentially we may open a discussion up with our customers around this as well. But in terms of strategic investors, we will talk to major shareholders following this discussion so that we can give them an update as well.
Right, okay. And just onto the project, now that you've started underground development, has there been anything different than what you initially expected, such as ground conditions or development rates so far?
Actually, Alex, that's a good news story. We are spot on budget, both on cost and development for the underground works. As of December, we had done 290 metres underground development, and the ground conditions are spot on. So Burncut, our contractor, is going hell for leather, and we're very, very happy with the progress of the underground.
It's great to hear. Well, that's it for me. I'll pass it on.
Thank you. Your next question comes from Levi Spry from UBS. Please go ahead.
Hi, Levi.
Good morning. G'day, Tony. G'day, John. Just a couple of quick ones on, the use of funds sort of update we got with the back in October, I think it was. So the 788, how do we compare that to what you've seen post this quarter? What elements can sort of get reduced in that?
Okay, so and I'll defer to John when I exhaust my limit of knowledge on this, but if we take the announcement of use of funds, there was the refinancing of the Ford debt, so you take that out, then there was 460, but there was a portion of that debt which was the cost overrun facility, which was in the tune of about 110 million. And then there was the capital reserve amount of about 150 that we wanted to have as our minimum balance as part of the ramp up. And then the balance was working capital effectively that we needed for the ramp up period. Now, it's that figure that's as a result of the changes that we need to review. But John?
Yeah, so Levi, if you're asking about the $352 million buffer that we announced to the market back in October, obviously as part of the termination of the current debt discussions that we've had, that buffer included the $110 million cost overrun structure. So if you deduct that off the 352, you're down at about 240. Now, clearly, we obviously need a prudent minimum cash balance as we move forward, and in operations, that might be 100 million, say, but in ramp up, you'd obviously prudently want a little bit more than that. So if you say that was 150, that then brings the buffer down to circa 90 million. And obviously, as a result of this Q4 forecast that's come out, a fair amount of that 90 would have been removed by virtue of the significant decrease in lithium price forecast.
Yeah, okay, thank you. I might come back to you on some of the capital lines. And just confirming, so Wood Mac, it's just one independent price forecaster that all of these banks were relying on?
Yeah, so as part of our long-form documentation, we agree on a price forecaster. The one the banks felt comfortable with and we felt comfortable with, was Wood Mac, because given that we've used Wood Mac through PFS, DFS, and now. And there was optionality under our lending facility to potentially consider an alternative benchmark and an alternative price forecast or a basket, but at the moment it is Woodmac.
Okay. Thank you. Thanks for your time.
Thank you. Your next question comes from Lyndon Fagan from JP Morgan. Please go ahead.
Good morning, guys. Just to clarify, how much is left to spend to get this project up and running?
Yeah. So we've mentioned that the 515 is what we've got cash in the bank. So you can safely assume that that's sufficient to complete construction.
And then you're saying you need obviously 150 mil for a cash balance during ramp up. So I'm just trying to figure out is there any gap here? Is it, what, can you just spell it out again for us, please, in terms of what you need?
Well,
because obviously the CapEx is coming down with not doing the expansion. That's the bit that's a little confusing.
Yeah, and so we've got to do the work, Lyndon, to revise. All this is fresh. We've got to do the work to see what amount of capital we need based on not accelerating the growth of the 4 million tonnes. And once we've done that piece of work, we then can understand the size of the debt that we need. But as I mentioned to Hugo, the previous announcement, basically we needed 460 million of fresh debt. Right? We had 760. We take away the 300 from Ford. We need 460 back then to do to conclude and ramp up the project to first tonnes and beyond. What we're saying today is we've got to look at reducing that 460 to another figure, right? Which we've got to do the work around.
Got it. And can you give us an update on what the mining cost is, please? So
we put out to the market in October that our mining cost was $73 a tonne. And that's where we stand at the moment. John, is that?
Yeah, I mean, that's right. So we obviously put out some 10-year guidance of, $650 a tonne. Obviously, as Tony's alluded to, there's a bunch of optimisation work going on at the moment, and we need to take a little bit of time to assess what that means, and we'll relook at those calculations.
Yeah, but the cash cost that we put out in October of $73 a tonne, I'm still confident in that number. And Burncut, as I mentioned earlier on, is progressing to schedule, on budget, and we're not seeing anything untoward in the work they've done to date.
So under a smaller configuration, you're still comfortable in the unit cost guidance that was previously provided?
I think so, because we've mentioned in our announcement that not only are we looking at capital reduction, the game here is to reduce our all-in sustaining costs, but given the material change of the revenue side. So it's not only the sustaining capital and the development capital, but we'll also take this opportunity to look at the C1 cost.
Yeah. And so in terms of modelling it now, is it just the 2.5 million tonnes of processing that you would advise us to do, or is there sort of
it's
efficiency gains on top? 3, sorry, yep.
3.
Okay. All right. And then as far as valuing the expansion optionality, I mean, at this stage, if you were to repay the debt, from your initial comments, you sound as though you're more bullish than Woodmac on your numbers, or your price outlook, I should say. Does that mean that if you weren't inhibited by that, you would be pressing ahead with the expansion?
Yeah, that's a good question. The house view, you're correct, is we're stronger than what we're seeing with a number of the forecasters, including Wood Mac. But the reality is, it's not the house view that goes into the banking model. The banks require an independent forecaster, so we're going to live by the independent forecaster's view. So that's the reality, Lyndon.
Well, I guess what I'm saying is that if there was an alternative means of funding the expansion, I mean, there's a lot of valuation that gets wiped out with this expansion coming out potentially for years and years. If there was an alternative to get funding that didn't rely on this banking syndicate,
I would look at it. Yes, I would look at it.
Got it. Yeah. Okay. That's it from me. Thanks, guys.
Thank you. Your next question comes from John Bishop from Jorden Group. Please go ahead.
Morning, Tony and John. Thanks for taking my question. Just in terms of assessing, I guess, the working capital requirement, which is what I'm assuming you're solving for at the moment, can I understand what sort of work is going into some of the ramp-up assumptions? I mean, are you relying solely on your DFS work back in November of 21 around recovery rates, I guess ramp up to processing throughputs, etc., or are you doing some stress testing around that as well, please?
Yeah, so our assumptions that we put into the DFS have matured substantially, John, since, I mean, the DFS is over 2 years old now. And we've got our own team working on that post the publishing of the DFS. And I think we've mentioned in previous announcements that we've used things like the McNulty curves in order to determine the ramp-ups. We've also learned from other startups, lithium startups, around recovery. So we've taken a very conservative view on initial recoveries that we will get from the ramp-up. So I think we're quite strong in that regard. I think they're conservative enough. We've also taken a view during ramp-up that the quality of our product potentially won't be as good as we would in steady state. So we've taken a conservative view on revenue as well. So I don't think those, I'll look at them, but I don't think we'll challenge overly our current assumptions in that ramp-up period, because I think we've given it a good scrub. And it's been challenged by the banking technical experts that they've brought in, and they've held strong.
Okay. Have you actually provided those sort of revised internal estimates to the market? I may have missed them, but I guess I'm still somewhat anchored to the DFS, ultimate recoveries, etc. But
so the short answer is no. We were going to do that as we get closer to first production, and I think the ultimate recovery of 78%. I think you should still hold. The question that we'll provide, or the answers we'll provide when we get closer into production, is when do we anticipate hitting that 78? All right?
Yep, no, that's fair. Just on those DFS inputs then, can I just clarify in terms of your unit cost assumptions that you provided with, I think it was the October update with the burn cut contract. They seem to imply, because I think you did it on a concentrate basis rather than on a unit of ore or rock basis. Were they also anchored to the original DFS assumptions on steady state in terms of 78% recoveries and 6% concentrates?
Yes.
Okay. And then just my third question is just around this refinancing process. Assuming the banks are obviously still supportive, are you looking to perhaps re-engender a corporate process to introduce some competitive tension? I mean, there's obviously been significant corporate interest in the last 12 months. Is a formal process part of your consideration?
No.
Okay. Thank you.
Thank you. Your next question comes from Sam Catalano from Wilson's Advisory. Please go ahead.
Yeah, g'day, Tony and John. if I can just push you a bit, obviously there's been a few questions trying to get to your cash requirements, particularly over the next 12 months. So if I understand correctly, so you're saying 515 gets you to production and then probably another 150 working capital as you ramp up. Just in terms of time frame, when on your sort of base case current assumptions, I know this is being reviewed, but when do you imagine the operation will be cash flow positive? Because obviously we're all focused on commissioning mid-year, but I don't imagine you're going to be positive cash flow from day one. So what's your current expectations with the current pricing environment?
Yeah, so yes, that's what I was going to say, Sam. We had a view as to what our point is for cash flow positive based on a quarter three forecast by WoodMac. The new forecast materially, given the revenue line's just been chopped by 60%, up to 60%, we're recutting those numbers now. But unless John has a more fresh number?
I don't have a specific number, but what I can say was, we were, under the Q3 forecast, we were predicted to turn cash flow positive in late 24, as Tony's alluded to. That will be pushed out, and we're currently still assessing, how far out that will be. But clearly, we also need to take into account all of the various changes that Tony's discussed this morning.
Yeah, so the key will be the balance, Sam, between how much can we take out of our capital requirements to make sure that we can bring that cash flow positive point back to where we're comfortable with, which was, as soon as possible.
Okay, great. Thanks, Jim.
Thank you. Your next question comes from Glenn Lawcock from Barrenjoey. Please go ahead.
Morning, Tony. Happy New Year. Obviously not a happy one for you. I'm just trying to understand the debt facilities. You've got the ECA facility, which was 200 million, and then you've got the commercial lenders were on the hook for the rest, the 560. Have you lost everything, the commercial lenders as well as the ECA facility, or is the ECA facility still on foot?
No, they're all a part of this. There's 8 banks in the syndicate. One of the 8 banks is EFA. Another one of those is Clean Energy Fund. Between them, there's about 300 million, and the balance is the commercial banks. So they act as a syndicate, so the whole syndicate, yes.
Is it one that's gone, or have they all gone? I mean, it feels like this has happened pretty quickly to you. You've been blindsided, yet you keep trying to tell us that the banking facility are very supportive and they're very strong towards you, but it feels like they've just left you. I would have thought something that was done 3 months ago. Is this basically the financial covenants being triggered by, I guess, your debt service coverage ratio with the WoodMac forecast? And is it one bank in particular, or are they all nervous?
Perhaps I can answer that, Glenn. No, we've had confirmation from all of the 8 banks that they remain highly supportive of the project. When we put the announcement out in October, we did say that it was subject to all of the necessary things that you would need to do to get to financial close. This Q4 forecast has come out in the middle of that, and clearly we are adjusting and dealing with that now. I can absolutely assure you that all of the 8 banks remain highly supportive of this project.
And just to further expand, just to be specific, Lynn, I mean, up to 60% reduction in price in the short to medium term. I mean, a 950 CIF number for at least 3 years. When we put it through the model, it would show that our debt service cover ratio was under stress. So that's what's triggered this review.
Okay. I'm just sorry to labour the point, Tony, but under the slide you put in the deck in October, the ECA facility looks separate because it's EFA are providing that, and then the commercial banks are doing the commercial lending facility and the cost overrun. So I would have thought all the commercial are different.
No, it's under one loan facility. The difference between the EFA and the Clean Energy Fund is the tenor, right?
Okay.
So they were 10 years versus the commercial banks was 7.
Okay,
and
but
because
everyone...
Sorry?
Sorry, you keep going. Sorry, Tony.
Yeah, and because of the longer tenor, there was a slightly higher margin for the EFA and CFC.
Yeah, but it feels like this has just been dumped on you. It feels like, because you don't have a revised debt facility to come with. So they've said, okay, we don't want to lend you 760. We'll consider something else. But they didn't. You've now got to spend time trying to sort that out, and now the equity market's reeling on the back of today's announcement. So I don't sort of find them all that supportive.
Well, it's triggered by the Woodmac price forecast, and then as a result of that, and we were testing it, the banks advised us late Friday evening that they couldn't extend the commitment letter. So, yeah, that's the facts.
Okay, but they are in discussion to maybe lend you something less than 760.
Yes, very, very much so. Very much so.
And you were talking to Ford about, an extension or increased debt with Ford. Is that something that you could potentially pursue and basically walk away from these banks, given they don't seem to be that supportive?
Look, we'll talk to our customers. The Ford debt facility is, in order to get the more money from the debt facility from Ford, we'd have to consider further offtake or some other condition for Ford, but we haven't had those discussions yet. So we'll put that in the mix as well as everything else.
Yeah, no, appreciate it. I'm sure it was a tough weekend for you. Just on the ramp up then in the 650 Aussie cost base, assuming, are we still thinking a 12-month ramp up? And you say you should exit middle of 25 at a 650 Aussie cost base?
The 650 Aussie cost base was an average over the 10-year period. And we also said at the time that the first few years it will be higher C1 costs because we're not at full capacity and, the amortization of your fixed cost base. So, we'll review that as part of this next piece.
Yeah. And just remind me the sustaining capital then. Are we talking something like, 50 million a year to keep the business going on top of the 650?
I think the sustaining capital that we announced previously was circa $171 a tonne. Obviously, as Tony's mentioned, that will now be reviewed basis the changes that we're looking to put in place.
All right, that's great. Thanks very much.
Thank you. Your final question comes from Stuart Howe from Bell Potter. Please go ahead.
Tony and John, just a little bit more around the banking syndicate. Can you talk a bit about who makes that up in terms of even just at a high level commercial banks versus domestic versus global, and perhaps if some of those are also lending to your off-takers?
Yes, so the 8 syndicate banks are the 4 domestic banks, EFA and Clean Energy Fund, and 2 international banks in SocGen and HSBC.
And you mentioned earlier that the Woodmac numbers are different from the house view. Perhaps again at a very high level, what's the big difference? Are they expecting more supply to come online, or is it on the demand side? Perhaps just some comments around that.
From what we can glean reading their quarterly report, they're expecting significant supply to come on from Africa and the lepidolite supply in China to stay sticky, and therefore creating this, and there's all this organic growth coming from existing players. Now, our view is the pricing signals that they're forecasting, by definition, would mean that some of that supply just will not come on. That's why we differ in our perspective. But, Woodmac has a different view.
And then finally, just talk around your engagement with off-takers, how that's going. Obviously, they'll be aware of this, and does that change anything from their perspective?
No, because as I mentioned when we kicked off, Stu, the 3 million tonne ramp up and first tonnes milestone is what we're targeting. So our offtake was always predicated on the first stage of expansion to 3 million. So, up to 450,000 tonnes of concentrate. So that still holds.
Great. Thanks, Tony.
I will make one other point just to cover off in the final summary. I mean, there was the question from Hugo as to potentially the savings. I don't want people to get the impression that it's the 70 million. We're targeting a change in the overall debt facility and a meaningful change. So that's the focus. And finally, we all have experience in the commodity cycle, right? And what we're experiencing now is just one of those cycles. So I don't want to be flat-footed for when the market turns. So there's a judgment call that we'll make as a board and as an executive around what levers we pull, because I've been in this game a long time and I can see when the market turns, the market will turn strongly. And we've seen where there's always these overcorrections. And potentially we're seeing an overcorrection now. So that's why there is no change to the base case. And as I think it was Lyndon that pointed out, if the market turns and it turns strongly and we have potentially access to additional funds, then we will review our strategy and bring back what we need to bring back in terms of our 4 million tonne case. All right. So thank you everyone for listening in and the questions from the various analyst community. I'll now conclude the presentation. Have a great day.
Thank you. That does conclude our conference for today. Thank you for participating. You may now disconnect.